So I think Ashburton's had a fairly consistent message for the last year and a half. We have been concerned about some aspects of the global economy. Clearly though, the macro data actually has got better. Mr. Trump's come in, he seems to have reinvigorated some of the animal spirits in the US economy. So that's good for the global economy. What we're more concerned, and the message we've been given for some time, is central bank action and the withdrawal or the ceasing of quantitative easing and the withdrawal of liquidity from the global financial system and the global economy. That's what concerns us more than the underlying macro state. The actual macro state is fairly long in the tooth, this recovery. By most standards, we're 8 years into the recovery, and usually you would be thinking we're pretty much at the top of the cycle. So we think we are actually near the top of the cycle, but plus also we are concerned by central bank action. So as we've been saying for some time, we are quite cautious with our asset allocation, and that view is maintained. Clearly though, markets in the short term still have moved higher. Going back to central bank action, certainly in our speeches to clients, as I said, over the last year or so, we've been talking quite a lot about what's been going on with that liquidity that central banks around the globe have been providing. And our view would be that we're coming to the end of this particular experiment that central banks have undertaken. There isn't, quite frankly, a great deal more they can do. So as they withdraw liquidity out of the markets, we are getting somewhat concerned that markets will start to price in some fundamentals. Now, if you look at valuations in various markets around the world, you could argue things are reasonably expensive. We don't think that is quite priced into markets at current levels, and one of the reasons for that is this liquidity that central banks have provided up till now. And it's quite interesting because we think that we're moving into a slightly different phase where we would argue that fundamentals are going to start to be repriced back into markets, and therefore that will have an impact on the whole active versus passive investing. The passive side, the ETFs and all those other instruments which have been gaining in popularity have obviously been very successful over the last few years. Our argument would be, as fundamentals get fully priced back into markets, there will be a role for genuinely active investors. So we're quite excited about the period ahead. We think there will be volatility coming up, but certainly we think there will be great opportunities for investors who have the speed and the capability to grab those opportunities when they come. Now, Ashburton as such, the international team, we haven't been sitting on our hands. We've been expanding our team over the last year to year and a half. We've been adding to our multi-asset team, which is mainly based in London. We have quite a young, very experienced team in very specialist asset classes, so we're very excited about the team we've been putting together in our London office. In combination with that, we still have the core of the team who sits in our Jersey office as well. We've got people like myself who've been here nearly 20 years and other members of the team who've been here nearly 30 years. So we've got the old and the new within Ashburton. So it is a good balance between experience and also looking at markets in the latest way. What we don't want to be doing is thinking just because we did it that way all those years ago. We also want to be exploring every possible avenue to create value for our investors. Obviously, in the offshore world, the international business of Ashburton is based in both Jersey and London. That is where our investment teams are located. Most of our multi-asset team, who look after our multi-asset funds, but plus also the asset managed funds, are actually located in London. And London is a great place to do business, particularly from an investment management perspective. We have a huge talent pool available in London and actually in the UK, and that certainly helps from Jersey's perspective as well. You have a talent pool, we can get hedge fund people, we can get people with a huge amount of variety and background that we can bring in to bring into our business, and we have been building our London-based team on that basis. We've been bringing new skills into our investment department, so we're very excited about that. And of course, London still is one of the major world financial hubs, and we have companies coming through. We have a huge amount of information at our fingertips being in London, so it certainly helps to be in London from that perspective. Jersey as well. Now we have some of our investment team based in Jersey still. Some of our products are still managed out of Jersey. And Jersey, actually, we're also building our investment team up. We're just actually adding a core equity research desk into our process as well, which we're just quite excited about as well. So from an investment perspective, we are adding to our skills base, we're adding to our team. We're very excited about the capability going forward.